Hello and welcome to the AgriFocus podcast from Agriland that takes a closer look at the issues that matter most to farmers across the country. Now, when Irish farmers sit down to plan fertiliser for the season, the last thing they're usually thinking about is a narrow stretch of water in the Middle East. But right now, the unfolding conflict in the Middle East is not only having a devastating humanitarian impact on the region, but it has also sent shockwaves through global markets and global agriculture. Within just 48 hours of the first strike on Iran, fertiliser markets reacted sharply. Irish farmers, of course, rely heavily on imported fertiliser, and it has a huge influence on farm margins here, especially in grass-based systems, where nitrogen plays a key role in driving growth and milk production. With Ireland already facing some of the highest fertiliser costs in Europe, any disruption to global supply chains can be quickly felt at farm level. So today we're going to be looking at what's happening in the global fertiliser market, why this conflict matters for agriculture and what it could mean for Irish farmers in the months ahead. And joining me today is Sam Taylor, an Executive Director with RaboResearch, which is a division of Rabobank. Sam, you're very welcome.
Thank you very much.
Now, you've been watching what's happening on the Middle East and the impact this is having on the global fertiliser market very closely. So let's start with the basics. Why does a conflict in the Middle East matter so much for fertiliser markets around the world?
So I think it's particularly the oil and gas complex. Let's start there. So nitrogen and phosphate fertilizers are the two nutrients which are the most viscerally exposed to this. And as derivatives of the oil and gas complex, they have a competitive advantage in their production area. So the Middle East is increasingly the most important region for competitive production of these products. And this is arguably the most important artery in the flow of nitrogen, sulphur, and phosphate fertilizers globally. But even that sits within a broader complex as well. So we've been most keenly focused on the Strait of Hormuz. But when you start to bundle in the other Middle Eastern regions, that actual number grows and grows and grows in importance.
Okay. And of course, you mentioned the Strait of Hormuz there. We never heard of it really before this whole Iran conflict has erupted. So why is that such a critical choke point?
Because of the competitive position of it. Actually, this was a relevance last year, actually. And I think a lot of farmers will be pointing to some of their inputs. And as you mentioned in the introduction, how expensive and unaffordable they are. But actually, we can look to the conflict that actually rose in June of last year and see how that is actually impacting fertilizer pricing for global farmers already. So one of the consequences of that very fleeting conflict we saw in June of last year was the impact on the sulphur markets. Sulphur markets, obviously, being a very important intermediate in phosphate productions. So any kind of disruption within that supply chain dynamic, and that region in particular, which houses Saudi Arabian production, Bahrainian production, Qatari production, Iranian production, Omani production, in that kind of area alone, it can have these very consequential ripple effects. Last year's impact on the sulphur, since sulphur prices in Q3 and Q4 just barreling upwards, and there were some consequences as a result thereafter, which have really squeezed the kind of marginal cost curve of phosphate producers globally and pulled off some of the kind of marginal production as well, tightening the global balance sheet. So we can look at this in two ways, in my opinion. You have the instant exposure, and you see the kind of price reaction that we've seen from fertilizers, which is in and of itself quite indicative of the importance of it. In the North American market where I sit, we saw some of those pricing dynamics jump about 35% on urea, in particular, on nitrogen products in particular. But we also saw a market where people were stepping back. They were waiting for this kind of the consequences to really land. What we really saw was a huge amount of what we'd call force majeures, basically people stepping back and saying, look, we don't really know the consequences of this situation, and we are going to have to wait and see before we commit to some of those previously committed contracts that we had signed. So it is a very narrow stretch of water. It's about 21-ish miles is my belief. But tucked behind that in the Persian Gulf is arguably the most competitive production and the most significant production platform for nitrogen production globally.
And I know you've been following this very closely in the last few days. And one of your research papers was sort of pointing to the fact that 25 to 30% of global nitrogen fertilizer exports pass through the strait. And that's huge, isn't it? So what happens really when that artery is closed off?
It's quite scary. It is very scary, to be honest, and it underpins global agriculture. I would say that actually some of the worst case scenarios, we have a little bit of a lead time in it. So when we look at the seasonality of this, we look at the Northern Hemisphere in particular, US where I sit, but also in Europe. A lot of the nutrients are within the supply chain, within the value chain, in market because of planting happening or having happened in certain cases. But we're also getting into this period where actually other huge deficit regions, particularly India, maybe also Australia, are going to start to ramp up their seasonal imports of nutrients. You kick this further down the road, you get towards the time period in, say, June, where Brazil starts to increase its inputs or import of nitrogen products. But this is global markets, and the opportunity cost of price is predicated on that next marginal ton, ostensibly. So if prices start to go up in one region, they will invariably start to go up in another region. These are both local and global markets. So if you have your nitrogen, if you're long your nitrogen, you've got plenty of nitrogen. This is, this is a consequence which hopefully we can kick down the road, and maybe if it resolves itself quite soon, we should be able to avoid the worst case scenarios. But for some other geographies, we are going to see some really important risks. And we highlight in the paper that 25 to 30% of global supply of exports of nitrogen products, principally urea, but also ammonia is very important coming out of that region. But the intermediates are also super important. So about 45, 50% of global sulphur exports come through there, which, as I mentioned, is very important in the phosphate production. But also equally important, in my view, and something that farmers will be very recently remember, is the flow of natural gas, LNG in particular. And what we have started to see already is some curtailment in production of nitrogen products in places like Bangladesh, which are very viscerally exposed to the LNG that flows out of the Strait of Hormuz. And obviously the European Union itself is an important recipient of a lot of that LNG that comes out of there, that liquefied natural gas, the natural gas that flows out of there. Very hard to reroute. So there's first order impacts, there's second order impacts, and then there's the third order impacts. The first order impacts are very much the fertilizer, which is not really flowing out of there. But we're also starting to see that kind of second order impacts of the curtailment of production in regions which we are less familiar with, but have exposed themselves to the LNG complex as well.
Yeah, and we see the situation is evolving every day, and sometimes from hour to hour, and markets are reacting to that very quickly, aren't they? Because we saw urea prices, for example, and urea has hit the headlines here in Ireland, jumped by about 20% in North Africa within 2 days. Is that quick reaction likely to continue?
I think that actually there's a chart, and I don't want to put fear into things. We sit here and we look at this with a sense of responsibility to not stir up fear, but the consequences of this are possibly underappreciated at the moment. And I do get the sense that from some of the rhetoric from the American administration that it's starting to kind of realize just how important it is. I'm not even touched on some of the downstream issues outside of the fertilizer space, which are starting to rear their heads, particularly in Southeast Asia, which themselves have exposure to this. So undoubtedly, that price reaction, in my view, was relatively rational. In the North American market, we had price increases comparable to what you'd seen necessarily in North Africa, some in excess, but they've continued to rise even this year, and they've continued to rise in places like Southeast Asia. where Australia is clambering for volumes as well. So it's not an irrational price reaction in my fear. In my view, I anticipate that there's going to be even more price reaction this week. And if this continues and we start to see further second order impacts of curtailment in production, bringing forth kind of curtailment for turnaround in certain areas, which is a real possibility in places like India. Potentially also areas like Pakistan, they might go from a supply neutral country to a deficit region. That could be an issue. And then also what we did see as a result of the conflict last year, and we have seen already, is that Israel is a very important supplier of natural gas to Egypt, and Egypt is a very important supplier of urea to both Europe but also South America. They issued a force majeure on their supply of natural gas to Egypt. Egypt is still producing as far as we can see, but given the fact that a huge amount of that is pipeline, the inventory of gas there is likely to be very little. So I think that this week we're probably likely to see further global curtailments, both associated with storage issues within the behind the purdah of the Strait of Hormuz, but also for supply of natural gas. And so we look at this in our internal dynamic on a sequence of timeframes. I think that the first innings, in my view, was the first week up until Monday, yesterday, ostensibly. And from this Monday through till next Monday, we're in a second innings. And it gets precipitously bad from each inning onwards. But then I think that from next Monday onwards, we start to view the possibility that we're going to see broader curtailment, broader curtailment within the Strait of Hormuz because of storage issues, but also more globally in Southeast Asia, potentially on the downstream products, which have kind of exposure, but also then on regions which are heavily exposed to Qatar for supply of LNG as well. So we want this conflict over. As farmers, in my view, because the most important thing to highlight is there is a differentiation between this and the conflict that we saw from Russia-Ukraine, in that we will need the input costs to drag commodity prices up. This is not a region that is very important or comparable in importance to the production of feed grains and food grains like Ukraine and Russia was. So this is very much a cost shock before it is a commodity price supply shock as well. So it is distinct and it is very different there.
You mentioned there about vessel traffic through the strait, and we've heard various news reports, that ships have been sunk, or that there will be continuing action in relation to that from the US. How quickly do you think that translates into shortages? I mean, are we looking at supply chains that are going to be impacted within the next 7 days?
I think supply chains in reality are probably already impacted. Some of the volumes that we've seen curtailed, like Bangladesh, they might only be about 7,000 tons per day that they are losing in production. But you've got slightly bigger soft curtailments in India, which are slightly larger. The loss of volumes through the Strait of Hormuz at the moment, and also the curtailment that has happened in the Persian Gulf already. Qatar, a very important supplier of nitrogen products to the global market. They started last week to curtail it. So we can literally already tot up and count the volumes of nitrogen that are being removed from the global balance sheet on an almost daily basis. It's not super significant at the moment, in my view, but it still will price in a premium to nitrogen pricing, which is going to last through this year. But with every day that this goes on, and with every action that is taken as a consequence of this, be that curtailment behind the purdah, be that curtailment in other regions, it just adds to that cumulative amount of nitrogen that is removed from the global balance sheet. And I think that from next week onwards, the start of next week onwards, that number will start to grow at a far quicker rate.
The whole issue around fertilizer production, it shows how interconnected, doesn't it, that global agriculture actually is now? Because sitting in Ireland, you might be in County Cork, you could be in County Westmeath, and you're thinking, well, why should I worry about what's happening in the Middle East? But it really does have a direct impact, doesn't it, on your farm?
It's a huge impact, and irregardless of anything else, these are globally traded products, which even if, as I'm sat here in the US market, you might have a particularly cheap cost base, natural gas in this market is particularly cheaper compared to, say, Europe, what is or was even in 2021 in particular. You price to the next marginal ton. So you cannot really insulate yourself from a global price dynamic. And when you start to get volumes taken off the global balance sheet, that becomes all the more apparent in proximity to you. But we take all these things for granted. And it's not just the nitrogen complex, it's also the trade of almost all commodities. You can look at the concentration of a number of these choke points. Okay, today it's the Strait of Hormuz, but you could point to the Straits of Malacca. You could talk to through the Black Sea at the Bosphorus. You could talk through the Panama Canal. You could talk through the Suez Canal. There are so many of these global bottlenecks that we are becoming over-reliant on, or we have always been over-reliant on, that it's in these periods of stress that we do become a lot wiser about the interconnected nature of it. And unfortunately, it dovetails down into some pretty unfortunate politics as well.
We know that Europe already has some of the highest fertilizer costs in the world. We've been covering that quite a lot here in Agriland. And Ireland obviously imports most of its fertilizer. We had that shock from the Ukraine-Russian war. Do you think that makes Ireland particularly vulnerable to disruptions like what we're seeing now?
Yes, undoubtedly. I think that when we try and model our pricing, we very often look to the biggest deficit regions for all the market signals. Admittedly, Ireland doesn't really have any form of kind of notable synthetic nitrogen or phosphate production facilities or capacity. But that's not completely unique, and it's not completely unique for agricultural behemoths. So you look at Brazil. Brazil doesn't really have much in the way of domestic production as well. I think that the chintzy number that's very often used is they require imports to sate about 95 to 96% of their nutrient demands across the NP and the K. And they're very good at giving market signals. So they obviously have to bid up the tons. And if you're a deficit region, you have no domestic production, you are most viscerally exposed to these kind of price spikes. And they show the higher highs for sure. And they showed the higher highs in 2021 and 2022. But you also tie it towards your agronomic practices. And I would say that in somewhere like Ireland, and as you can tell from the accent, I'm from the general region and have a lot of experience in agriculture across Western Europe. The capacity to pivot potentially towards non-synthetic nutrients is a great virtue, in all honesty. I come from a broiler producing family, so when we can use the chicken litter rather than some of the synthetic products, it is a very kind of cathartic reality. And it speaks towards, in my view, the virtues of that kind of Verbund structure of agriculture, where you have a little bit more circularity and you are owning a lot more of your kind of optionality and your ability to offset some of these input costs as well.
Farmers here have been battling with very wet weather, and so we've had issues getting some of our natural benefits that we have out on fields, and so that's that's been just one of the problems that we've had this year. But I suppose the other issue is that farmers are very strictly tied with environmental legislation now in Ireland too. So there's a lot of different constraints there at play, and I suppose something like what's happening now in the Middle East has put a spotlight on that too.
Yeah, it does. And it puts a spotlight on a lot of the other policies. Obviously, one of the reasons that Europe mainland and Europe, I suppose Ireland as well, was able to obfuscate some of the worst dynamics here and not finding themselves quite so hand to mouth on nutrients was because we had the imposition of the carbon border adjustment mechanisms, CBAM. And so there was some front loading on the nutrients. In the North American market, it's slightly different. We have really bad farmer margins, poor economics. So one of the marketing strategies that was used by people along the value chain was to commit to volumes, commit with a soft commitment, but no need to put money down. And I would say that those commitments are probably a little bit more vulnerable to this price rise than if you actually had your nutrients in hand and in market. North America is slightly different in the fact that we do have quite a large, particularly if you talk about the contiguous North America, we have quite a large nitrogen, phosphate and potash production system. So hopefully we can avoid some of these worst case dynamics. But for sure, these situations, they always raise the specter of whataboutism kind of dynamic. So in 2022, we as a bank would get a whole load of propositions about financing in market systems or alternative forms of production of nutrients, be that more biological, be that more micro scale, all these kind of dynamics. And we're going to go through that wave again if this persists. We're going to go through the question about whether we need more green ammonia, more blue ammonia, more biological alternatives, these kind of things to try and insulate ourselves. And I use ourselves more broadly as like literally everyone, Brazil, US, North America, Australia, everyone, from these kind of supply shocks, because there is a path dependency top to bottom on the way that we apply nitrogen, the way that we apply phosphates. Farmers make the capital investment, the machinery investment. A new nitrogen plant is thousands of dollars, billions of dollars to produce, long time scales. We are very rigid in many contexts, but these kind of scenarios do provide us a real awakening as to the potential risks if things get really bad.
Yeah, because for example, dairy farmers in Ireland are especially reliant on nitrogen fertilizer for grass growth. So, any spike in fertilizer prices then impacts on your farm profitability, doesn't it?
Yeah, and I kind of, so when you look at the imports into Ireland, calcium ammonium nitrate, that's not necessarily something that's got a direct exposure to the Middle East. There will be some urea that comes from North Africa, but they will be impacted. I mean, CAN largely comes from the European Union, which is not impervious to the price of natural gas shifting its cost curve and increasing that cost. So I'm not sure who will be able to insulate themselves from this scenario, unfortunately. And we will be paying the price for this one way or another, possibly in second and third order impacts, which we've not necessarily really considered at present, probably long into the end of this year, but into next year as well.
So you don't think this is going to be like a temporary shock that's going to go away, but something more structural?
No, I don't think it's going to be structural, but it's the kind of resonant wave that occurs. And like kind of the conflict that happened in June of last year, where Israel and the US attacked Iran, the kind of the barreling effect there, and I gave a loose allusion to this earlier on, is that caused some limits on exports of sulphur out of that area, which sent that price a little bit higher. You then had some compounding issues about sulfur supply out of the Middle East and out of Kazakhstan, strong demand for sulfur out of Indonesia. But that sent sulfur prices barreling upwards. And then what you got a kind of beggar thy neighbor scenario where Russia then decided that they're not going to export the sulfur. So when we look at the state of global politics and the broad level of demagoguery that we see, I think that it's not unfair to assume that beggar thy neighbor dynamics come into play here. And I don't use that in a wholehearted sense of cynicism, but the global fertilizer markets at the moment are on the P and the N prior to this conflict were very much framed in the context of China stepping back. And there's no judgment put on that in China. China's objective is to ensure that their global agricultural production has the cheapest is as cheap as possible for Chinese farmers. But in so doing, they step back from the nitrogen market. They step back from the exporting market on the phosphates as well. And the current basis was that they would start to export urea in Q2 at some point, phosphates in Q3. But if prices are materially or structurally higher globally, there will be the fear that if they open up the doors and allow for exports, that they might pay the price later on. So these kind of dynamics, what they have done and what we saw from that short conflict last year in June was that countries are more predisposed to a beggar thy neighbor kind of strategy as well, and go, you know what, we need to make sure that our people are sated for food demand and that our agricultural systems are in good tact. And we need to prioritize that above and beyond being a supplier to the global market. And there is a risk that that happens. as a result of this. And that risk potentially grows with the longevity of this conflict, in my opinion.
So I suppose what Irish farmers will be looking to know today is, will markets settle down just as fast as they spiked if we do see a resolution to this conflict?
We're going to price in a war. I mean, the chintziest way we say is we're going to price in a war risk premium that's going to be structurally higher. We're not going to get to urea prices dropping back to where they were 10 days ago in the same way that we didn't last year. We got some hundreds of thousands of tons ripped off the global balance sheet by Egypt's curtailment last year as a result of the kind of force majeure on supply of natural gas. Prices did not rebase back down to a pre-war dynamic. This appears to be a more consequential conflict at present. So the notion that nitrogen prices are going to give up that 25 or 30% price with imminence, I think is unrealistic, given the fact that we have seen some consequences. And if this goes on into next week, then I would be even more confident making that statement. We're going to be paying the price for this probably into winter wheat planting dynamics.
And then the other big issue is, is there going to be a disconnect between fertilizer prices and agricultural commodity prices? Because our farmers keep a very close eye on commodity markets. And that's going to be something that they're going to be thinking about now for the remainder of 26.
Yeah, I mean, yes, I think that's a very real risk, but actually it's a reality that we've been seeing in the North American market for the last couple of years. Affordability is the most talked about kind of dynamic, phosphates being the worst in the North American market. And prior to, I don't know, about 6 or 7 months ago, that was really quite a idiosyncratic reality driven by domestic policies, bad policies, in my view, which was causing that. But it's now a kind of a global dynamic. But we've seen that divergence in commodity prices versus input pricing, probably from about, I'm going to say August of 2024 has made that real departure. So affordability is going to be a real issue. And unfortunately, as every farmer will know, just because you pay a little bit more for your nitrogen doesn't mean you can turn up at your marketing station and go, well, I paid a little bit more for my nitrogen, I now want a little bit more for my commodity prices. It doesn't work like that. Ultimately, what we really need to see, we don't need to see, that sounds very callous. What should happen economically for commodity prices to run up is a nutrient deficient yield drag in certain geographies to pull that up. Because as I mentioned prior, it's not a commodities, agri-commodities exporting bottleneck. It's a cost bottleneck that comes up. So if we start to see that there is some drag on yield as a result of farmers cutting back, that's probably going to be the most obvious catalyst for commodity prices running up and kind of potentially closing some of those affordability issues for growers.
So while we see the Middle East conflict unfolding on the other side of the world, the impact could soon be felt much closer to home, and we know right here on Irish farms and on fertiliser bills in the months ahead. But for now, that's where we have to leave this episode. So my thanks to Sam Taylor, an Executive Director with RaboResearch, for joining us and sharing his expertise with us today. And thank you also for your company. And if you do get a chance, please don't forget to rate, review our AgriFocus podcast on Spotify, Apple Podcasts, or wherever you get your podcast. Goodbye.